We can all please take our seats. We'd like to call the workshop to order. First order of business will be to call the roll.
Rob Fechner,
Good morning.
Teresa Taylor,
Here.
Margaret Brown, Henry Jones, Fiona Ma, represented by Matt Seha, Lisa Middleton,
Present.
David Miller,
Here.
Stacy Olivares,
Here.
Irena Ortega, Jason Perez, Mona Pascual Rogers, Ramon Rubalcava, Betty Yee.
Thank you. The next order of business will be approve the committee timed agenda. What's the pleasure of the committee? Moved by Taylor, seconded by Miller. Any discussion on the motion? Seeing none, all in favor say aye.
Aye.
Opposed, no. Motion carries. Thank you. Item 3, the Investment Education Workshop. Mr. Meng.
Thank you, Mr. Chair. Good morning, members of the Investment Committee. So today we continue with our board education workshop, and we are truly honored to have two distinguished guest speakers with us today. So first we have, I will introduce the first speaker, and then my colleague Dan Bienvenu will introduce the second speaker. So the first guest speaker we have is Mr. Hiro Mizuno, the Chief Managing Director and Chief Investment Officer of Japan, the Government Pension Investment Fund of Japan, the GPIF, the largest pension fund in the world, and one of the largest pool of assets in the world. You have his bio in front of you, and I was hoping to find a abridged version of his bio on Google, and that was a mistake last night. It goes on pages after pages. So it's sufficient to say that Mr. Mizuno joined GPIF in January 2015, and since then he has served as the Executive Managing Director and Chief Investment Officer. And prior to joining GPIF, he was a partner of Coller Capital, a London-based private equity firm. And later you will see that in his presentation, his experience working as a GP in the private equity industry has really benefited him and the GPIF in terms of designing their program. And also, as you will learn later, that GPIF manage almost all, if not all, the assets by external managers. So the relationship between GPIF and the GP communities is of more critical importance to them. In contrast, we manage about 80% asset in-house, but still we have 20% asset managed externally, so we can really learn a lot from Hiro's creative thinking in terms of designing long-term alignment in terms of economic interest with the GPs, and also in terms of applying ESG principles, and in the time horizon, how to become a long-term investor when you engage external partners. Before he joined the private equity firm, he worked at Sumitomo Trust Bank in Japan, Silicon Valley, and New York. He's also a member of the board and asset owner advisory committee of PRI, co-chair of the Milken Institute of Global Capital Markets Advisory Council. He's also the founding member of a Climate Finance Leadership Initiative, the Global Investors for Sustainable Development, Development Alliance member, and the Global Business Coalition for Education Advisory Board member, and also Asian Advisory Group member of Climate Action 100+. And as you see, that these are the activities that CalPERS we have been actively engaged in, and Hiro and GPIF has been a great partner with us on these important global initiatives. So for that, we want to thank him and the GPIF for the great partnership working with us. I could go on, there's a long list of his also participation with the Japanese government at different levels, and also his involvement with the academic community. So it's suffice to say that he's, in addition to be one of the global leader as a practitioner, he's also a global leader in academic, the thought leader as well. So without further ado, I will turn over to Mr. Mizuno, who will share with us on how to design a long-term relationship with GPs to align with the economic terms and our value. So with that, please put a round of applause together.
Good morning, ladies and gentlemen, and it's my real privilege to be able to present GPIF and our strategy to world-famous CalPERS board. I cannot help calling you judges because you appear to be like a judges to me. So it's a bit intimidating, but I try not to be intimidated and try to be open to share with you what we are trying to achieve at the GPIF. And also, as the Ben mentioned, we regard CalPERS as our most important strategic partner. And we also think we are most alike with each other because when we talk about the business model of the public pension fund, global asset owners, a lot of people try to compare GPIF with the CPPIB Canadian or like a Norges and some Scandinavians, but they are working in very different regulatory framework or environment. So I always feel like CalPERS, and also I saw my friend from CalSTRS in the audience. But I always feel like CalPERS and CalSTRS are our closest allies in terms of the environment we are operating and the sort of the significance in their and our capital markets. So I first of all want to express my gratitude for continuous relationship and a partnership between GPIFs and CalPERS. So today, I really don't know exactly what interests the board, the CalPERS board, about what we have been doing. So let me start with the introduction of GPIF to you, who we are and how we operate. And I think that maybe interest is of interest of a CalPERS board, how the board should or would work with the investment team to optimize our performance. So let me start with the quick snapshot of us. We at the moment managing the 1.5 or 1.6 trillion US dollar worth of public pension reserve fund. And our performance since we started our market investment has been like an annualized return of 3%. And we made roughly 621 billion US dollar gain since we started. And as you see the graph of accumulated the gain, you can see there's a huge pickup over the last 5 years, which is because we changed our policy asset mix when I arrived at GPIF from 75% in the fixed income and mostly in Japanese government bond to 50% in global equities and 50% in global fixed income. And we got approval to invest into the alternative assets up to 5% when we revised the policy asset mix. But unfortunately, at the moment, we are still have only less than 1% exposure to alternative asset classes. And I was actually on the other side when the GPIF decided and approved our current policy asset mix. And there was a big argument that the GPIF should have like a 20% exposure to private equity and real assets. And I spent 20 years of my professional career managing private equity, and before I was called back by Prime Minister to run this fund, I was a partner of the one of private equity fund which the CalPERS used to maybe still invest in, and then I knew how difficult to deploy a huge amount of money in a private market. That's why we agreed to have not even have a 5% allocation, but a 5% cap, and. At the moment, we haven't even reached the 1%, which is for us is not a small amount of money. So this has been what we have been operating. And as I just described, our policy asset mix is now 50% in global equity and 50% in global fixed income. And 35% we have to invest in the Japanese domestic bond, which is mostly Japanese government bonds. And given this allocation and our fund size, we usually say we own about 8% to 10% of Japanese listed companies, and we own about 1% of the major US companies. So our exposure to the U.S. economy is quite significant. And in that context, I think the CalPERS and the GPIFs are one of the biggest owner of the U.S. public equities, meaning we are owner of the U.S. economy. So it's very important for us, the U.S. economy continue to have the healthy growth. And I'm going to talk about it later, but our universal ownership approach, meaning we are the biggest beneficiary of economic growth or healthy commercial activities. So that's why we need to contribute to make the whole system more sustainable. And that concept came from this asset allocation, which we ended up owning whole capital market. So just to give you a snapshot of who we are from different angle, we are the manager of the Japanese Public Pension Reserve Fund. Why we need a reserve? Japanese pension scheme, a public pension scheme, that's actually designed as a pay-as-you-go scheme. But the problem is, for the pay-as-you-go pension scheme to be sustainable, we need to have a younger generation to support retirees. But as you know, Japan is going through the huge aging, transformation, and for the next 100 years, we're probably going to suffer from the reverse age pyramid. So we don't have enough young people to support the pay-as-you-go system. So, 15 years ago, I guess, like a Japanese government came up with a very audacious, experimental, the idea of, the hybrid mechanism, which is basically it's pay-as-you-go system, but for the next 100 years until the age pyramid go back to normal, they make the best use of the fund already, the saved or contributed from the previous generation. So that's the fund GPIF is managing. So our role is to make a return from this reserved fund to fill the gap, so that our younger generation is not going to suffer from too much burden to support the older generation. So this is actually the graph trying to illustrate how important GPIF fund is. You can say that it's not as important, or it's still very important. For the next 100 years, the chart describes how much money the public pension scheme have to pay out to retirees. And GPIF fund is going to be responsible about 10% of future liability of Japanese public pension scheme. As you can imagine from our, aging society, even last year, our public pension scheme paid out about $600 billion. And we are still at the entrance of aging society. So you can see the magnitude of the problem caused by aging society. And so the GPIF is meant to, bridge the gap, so pay out the other 10% of the future liability, and we are designed to disappear in 100 years' time. So coming back to the governance structure, which I think they may be interesting to the CalPERS board. GPIF is under supervision of the Ministry of Healthcare and Labor Welfare, because historically the pension was regarded as the labor welfare. So we are under supervision of the Ministry of Healthcare and Labor Welfare. And we have a board of governors, which consists of 10 representatives, and which all appointed by the minister of the ministry. And now we have 10 members. And today I was impressed to see gender diversity on a CalPERS board. We only have the 20% of the female representative out of 10. But naturally, women tend to live longer in Japan, so probably in some time that we will lose one man representative. So. But I think we are the supporting member of the 30% coalition. I feel embarrassed every time we have only tell them we have only 20% of female representative on our board. But we have a board of governors who make all the strategic and high-level decisions, namely policy asset mix, And we also need to get their approval when we start a new investment style or new asset class. And we have a clear, separation of governance of execution. And I'm executive managing director and a CIO responsible for the investment office. And then we started this new governance structure about 2 years ago. Before, there was a huge criticism, like, the GPIF is operating under political pressure, which was not really the case, because I never felt political pressure when I make an investment decision. But there's a perception among Japanese the public that the GPF is under political pressure to make some particular investment. So because of those concerns, the government came up with a new governance structure, which was put in place about 2 years ago, and we are operating in that the governance framework. I would like to talk about the philosophy and strategy, how to promote the long-termism. But I'm happy to take questions if you want to ask me about our governance structure or about the GPIF, so that you probably be able to understand my remaining presentation better.
Very good, thank you. Ms. Taylor.
Thank you. See, I told you we ask questions. I was curious. You said you had some political pressure. The government.
I didn't.
Not you, but I mean the pension system. What was the structure as opposed to the new structure that was put in place?
Well, we used to have the what they call the investment advisory committee as the council to GPIF.
Okay.
So the board of governors meant to divide us from the political leadership.
Oh, I see.
Yeah,
Okay.
that's the whole purpose of this, the new governance structure.
Okay.
So, I forgot to mention, but the 10 representatives, 2 came from finance or investment professional or academics, and 2 from the 2 are former central bankers, and 1 representing the business federation or like a chamber of commerce kind of things, and the 1 representing biggest labor union, and 1 representing, one is a lawyer, the other is a CPA. So that's the sort of composition of our board of governors.
And they're all appointed
They are all appointed by minister. Yeah.
by the minister. Okay.
Yeah.
And then what I'm seeing here is it looks like what's your rate of return? Is that the 3.3%?
Yeah,
currently?
well, we are required to make 1.7% plus real wage increase with minimal risk. And I really don't think that's the best way to describe, or that is the best instruction to give to the investment team, but that's what we are operating with. If we make the 1.7% over real wage increase, that should satisfy that 10%, the responsible, the 10%.
The reserve
benefits.
fund that you're talking about? That's what you're saying, that should satisfy the reserve fund?
Yeah, that's right.
Okay, so you guys are fully funded? Is that what I'm assuming?
Yeah, well, it's tricky to say fully funded because it's a pay-as-you-go scheme.
Right.
And as you see on this graph, this government contribution is basically it's a tax. So it's very difficult to describe whether we are fully funded or not, because that actually take it into account. They will get a subsidy from the tax, the account, and then also the other annual pension premium paid by the other working generation, and then reserve fund.
And you have that discrepancy now between the aging population and a much smaller population contributing in to the fund. That's what I was curious about, because it sounds to me like we have a similar situation with our aging population. We don't have a pay-as-you-go scheme necessarily, because we have to hit a certain rate of return to make sure, and be fully funded to make sure that we pay
Yeah, I
our
think
benefits.
I think for the next 25 years, we have net inflow of the capital. And after that, we will get into the real serious like a distribution more. And so I think that compared to Ben, one of very few privileges I have is I probably don't need to worry about the payout for the next 25 years. So we can just focus on more long-term investment.
Yeah. So as Hiro said, there are a few key differences between us and GPIF. One is the current liability. As Hiro just said, at least for the next 25 years, they don't have projected current liability payout. Currently, we pay out more than $20 billion a year. And the other thing that, as Hiro just mentioned, GPIF is designed to go away in 100 years. So there's a termination date. CalPERS, our fund, we don't have a termination date. It's supposed to be a perpetual fund. So these are the key difference. And also, as you point out, our required rate of return is 7. Is much higher than their required rate of return. But that difference aside, there's still a lot of things we can learn and benefit
Oh, yeah,
from there.
yeah. I'm just trying to help figure out the similarities as well as I didn't realize. I think I took it differently when you said there was a 100-year date. So why would the pension system go away in 100 years? Have
No,
you guys just?
it's the GPF will go away, but the pension scheme will continue, obviously.
So the whole.
Now we have the age pyramid, which is almost like a pillar.
Oh, yeah.
And then going into the reverse age pyramid, and then those generations will die and go back into normal pyramid, right? And
Okay.
The Japanese government project that transformation will take another probably next 100 years, and during that period, the burden on the young generation is going to be unbearably heavy.
Right.
So that's why they came up with the idea of using this reserve fund, which I'm managing, to fill the gap, so
Got
that
it.
the other younger generation wouldn't suffer outrageous the pension burden to pay to the retired people.
So basically, the hope is that within 100 years, Japan will be able to reverse the aging trend.
Right.
Yeah.
Right.
That,
Okay.
that's a bold assumption of them, but
Let's hope so.
well, I hope so too.
Thank you.
Thank you. Ms. Yi?
Thank you, Mr. Chairman, and welcome here. It's really wonderful that you're here. I had a question. Since you're a national fund, and you talked a little bit earlier in your introductory remarks about the differences in our regulatory framework, so who regulates you?
The Ministry of Health and Labor Welfare.
And so, and part of why I'm asking is that I know you really did some great work in terms of corporate governance improvements and reforms. And so, are those policies advisory that come down from the government of Japan, or are you self-regulating? I'm just trying to get a sense of where those, how you treat advice and mandates.
Yeah, well, that's a very good question, Betty, and I try to answer the question as effectively as possible. Let's take the ESG as an example.
Yeah.
4 years ago, we started a campaign to integrate ESG into our investment strategy, and we started calling for the corporates to align their business with all those ESG requirements. At that time, we received a criticism from some media like, I'm under pressure by the Abe administration. We are trying to promote the corporate governance reform, and that's why I'm doing it. And I keep refusing that argument, saying like, I think taking ESG into the investment analysis make 100% of financial sense. And nothing to do with the Abe administration want to promote the corporate governance reform. Yeah. But that's the kind of the general perception which we struggle with. So to address that kind of misperception, government came up with that governance structure, trying to make us look like as distant as possible from the policymakers. But in reality, I never brought the policy agenda into my investment decision whatsoever. And the ESG integration, ESG campaign for me, it just really makes sense for, as the universal owner, to protect our fund from the capital market volatility or like a systemic risk, we are facing like a climate change.
Yeah.
So I think sorry, I couldn't sharply answer your question, but it's nothing to do with the Abe administration's policy that GPF promote corporate governance reform of Japanese corporates.
Okay, yeah, that's a good example. And then with respect to your assets, how much of it is internally and externally managed?
We are regulated not to take any equity investment in-house. So the 100% of equity portfolios managed by external money managers. And for the fixed income, we actually can manage all the fixed income in-house, but we made a strategic decision to only manage domestic fixed income in-house. So 100% of the foreign fixed income and 100% of global equity portfolio are managed by our external managers.
Okay, great. Thank you.
Okay.
Thank you. Mr. Perez.
Mr. Mizuno, thank you for coming. On one of your slides, show 3 tiers for employees. Can you walk me through, please?
This one?
Yes, sir.
Okay.
So if I'm a new employee, where does?
Okay, we are like the U.S. Social Security. So there's a national pension, whether they are student or whether they are working for the company or they are self-employed or they are homemakers, regardless of their jobs, they are part of this national pension scheme. So literally every single Japanese are our beneficiaries for this national pension scheme. And on the top of national pension scheme, we have employees pension, but this is mandatory. And GPF managed the fund contributed by those national pension as well as the mandatory employees pension or corporate pension. And the big corporates like Toyota, Nissan, those guys, they have their own the pension on the top. So the third layer is up to the person or the company you work for. So not everybody has the luxury of having that third layer, but every single Japanese has the first tier or first layer, and the people who work for the corporates also entitled for the mandatory, the second tier pension scheme.
And the national pension, that's the tax you referred to? The national pension for everybody, the basic pension?
Yeah, this is a basic pension. This is a Social Security.
The tax you referred to earlier?
Attach?
The tax.
Well, this is not tax, but they are collected together with tax. So those like that graph I showed, that the subsidy came from the government came from the general tax account, and the middle layer it was directly contributed by the taxpayers. But it's collected together with tax. So a lot of Japanese people think that the pension contribution is also more like a tax. Yeah.
And the employee's pension, is that the employee paid or is that the?
It's half-half. Yeah. So basically the corporate have to match the contribution by their employees.
Thank you. And then what's your staff size and your operating?
That's a good question. We have only 135. People working. We don't have the administration side of corporate, so basically it's the investment office. We have 135, and our cost of operation is very low, but we paid about $500 million to the asset managers to manage our portfolio. So it's just a strategic decision and also regulatory preference. For GPF not to manage the equity in-house. Because if you think about it, we own about 10% of Japanese corporates. And now our relationship with the Japanese corporate community is very, very, very positive. But 4 years ago, when I was called by Japanese government to leave London private equity shop to run this fund, Japanese corporate was very concerned about the GPF becomes like the private equity fund manager. So the regulator made it clear GPF is not going to manage the equity portfolio themselves, so that we're not going to be sort of like a dominant shareholder in a Japanese, the private sector. So that's a background why we don't take any investment in-house.
Thank you very much.
Thank you.
Thank you. Mr. Jones?
Yeah, thank you, Mr. Chair. Good to see you again.
Good to see you.
Yeah. As you know, CalPERS has substantial investments in Japan, and maybe right before you came, I was with a group that went to Japan to talk about corporate governance because we were concerned about our investments in Japan. So I know that you've implemented a strategy under corporate governance now. So could you kind of give us an update where you are in that strategy?
Sure. It's probably makes sense for me to go through our ESG initiatives to address your question more clearly, because we never separate like a corporate governance issue from like the other issue like a social or environmental issue, because we promote ESG investment altogether. So for us, a corporate governance is one of ESG issues rather than one specific issue. So let me, if you run out the question on the who GPF is, I probably wanted to just move on to the other slide to address the Henry's question better.
That's fine. Okay.
Mr. Chair?
You done, Mr. Jones?
Yeah. Oh, no, I did have another one. Go back to the chart that shows the governance structure. The audit committee, it says that it's the same body of members that are part of the board of governors that's part of the audit committee. So what's your relationship to the audit committee, and do you have an internal audit committee?
We do have an internal auditor as well. So, but this is the only one committee the board has. Like the CalPERS case, they have the investment committee as well as what's the other one?
Health and
Pension and Health, the committee. For GPF, the only one committee the board has is the audit committee, who works as a sort of semi-external auditing board. And also, one permanent board member is stationed in our office to report to that audit committee. So it's very rare for me to work directly with audit committee. But audit committee works as a bridge between investment team and a board. So I don't, GPF meet with our board every month, but only for 2 hours. So it's not like CalPERS. I don't know how many days you meet every month, but we meet like 3 days. Our case is 2 hours or 3 hours. So this audit committee function as the sort of liaison between the investment team and the board. So that we don't need to they report everything in detail to our board.
Okay, thank you.
Thank you.
Mr. Miller?
Yeah, thank you for taking the time to spend with us, sir. We really appreciate it. I'm kind of curious, for us, having kind of direct engagement with our beneficiaries and the members we serve is a big part of kind of the transparency and accountability and results equation for us, and things like this generational equity issues that are really important to them. So for you, in your system, what's that relationship with the members, the beneficiaries like? Is that through the Board of Governors or through the voice of the customer via the government, or do you interact directly with them in some ways? Like you can see in our audience, we always have very active members and organizations to communicate with us.
Thank you. That's a very, very good question and very important question for us. And when we had been discussing, we were discussing about this new governance structure. That was one of the topic being discussed very heavily, because now it used to be GPF investment team was also responsible for policy asset mix. So the other investment team before this new governance structure felt full-heartedly responsible for the performance. But now, actually, they pick up the CalPERS model, and the Board of Governors decide policy asset mix. So to be fair, 80-90% of performance was actually dictated by the board decision. Yeah. But in reality and in the real world, nobody hold the board accountable for the performance. It's going to be investment executive. So nobody want to listen directly from our board about our investment. So it's got to be us who try to communicate with the general public how we manage. That's something I always feel unfair, to be honest. But yeah, we're not alone. But the basically board make those kind of very, very critical investment decision. But when GPF try to communicate with our stakeholder or beneficiary, with the Japanese general public, and also usually we reach out to general public through media. Media only interested in our explanation how we are managing it. So we take that responsibility. Given we don't have a target audience, it's always really difficult to communicate and or convey the very clear message because we have no idea who's listening. And at least the CalPERS beneficiary, in my opinion, in my the understanding, at least served for the public, for the local government. So the people seems to have the public mindset, I guess. But we are serving every single Japanese person who has a totally different opinion from each other. So the communicating well with the general public is such an impossible job for us. So we created a lot of reports, and we put everything on the internet. Well, we don't broadcast the board meeting like you guys do, but we put a lot of information on on a homepage. But we always get criticized. We are not transparent enough, which I think is an impossible task to achieve. And if you don't mind, I just wanted to talk about the transparency. Over the last 4 years, we continue to increase our transparency, but as a result, we haven't been able to affect the people's perception or expectation of the GPIF. So I concluded transparency itself wouldn't solve the problem. Okay, and I always feel like the board and the people, particularly people from the investment industry or finance industry, expect the investment team to outperform the market. But in reality, if you take the analogy of NBA, like the basketball team, CIO is like the head coach, and all our conversation of our game plan with our owner or the executive has to be broadcasted. Beating the market, managing a public pension fund is almost impossible job. That's one thing I wanted to just convey to the board of CalPERS. Transparency sounds good, but in reality, it really make investment team play handicapped game. So we started discussing which area we should be strategically transparent, and which area, which actually information we should be strategically less transparent. I'm sure that I understand that at the CalPERS board now the private equity is one of the hot topic. I used to manage one of the biggest private equity fund, and a private equity fund delivers better return. Nobody argue about it. The reason why, because we are playing the game of not transparency, with a lot of private information, right? So on one hand, I think GPIF and CalPERS has to continue to make an effort to have a better communication with their stakeholders, but I would like to ask our board as well as the CalPERS board to be empathetic to the investment team who have to operate in that kind of handicapped environment. It's really hard. The quarterly, we need to tell them our asset allocation. When we started discussing the new policy asset mix, we are under pressure from the general public. We need to disclose it. It's very difficult to manage the fund in that kind of circumstances. If you don't request us to outperform the market, it's fine. But all the board expect the investment team to outperform the market, and without the operating with that kind of a transparency requirement, it's just impossible. So I think think the board and the investment team need to work together to improve the communication with the stakeholders, but increasing the transparency doesn't seem to be deliver what we are talking about. So that's another reason I feel always sympathetic to the CalPERS, because we are under very similar pressure by general public and also the media about what we are doing.
Thank you for your insight, sir.
Thank you.
Very refreshing to hear those comments, so thank you.
Thank you.
Middleton.
Okay.
Thank you, Mr. Chairman, and thank you, sir. It's a pleasure to hear your insight. I'd like to shift gears a bit. You've got incredible experience in the global economy. As you look forward over the next few years and the next 25 years, what are the most significant concerns that you have that would cause major disruption to the global market economy?
Thank you. That's a very good question. And several issues I'm very concerned about. You know, I think the Ben probably the same, but every time I'm on the panel at the conference, the moderator try to ask me what keeps me up at night. And I always answer that it's Netflix, but and YouTube. But I watched the 4 CalPERS board video on my way into the San Francisco. It totally kept me awake, 11 hours. But the one is the aging society in a developed market, the developed economy. You know, Japan has been trying everything to get out of deflation over the last 2 decades. We still haven't been successful. You know, how much money Japanese Bank of Japan printed and how much stimulus Japanese government implemented, still we cannot get out of the deflation. And it obviously has to do with the aging society. And the globalization of the economy, and basically just made the other manufacturers' job impossible to transfer their cost into the final consumer pricing. So there's a huge pressure to keep the other price down and inflation down. And GPF is now allocated 50% of our portfolio to fixed income, hoping fixed income portfolio provide a hedge for the other, the drawdown on the equity portfolio. But last fourth quarter of 2018, GPF reported it's only mark-to-market loss. It's not real loss, but the mark-to-market loss of $150 billion just over 3 months. You know why? I have been in this industry throughout my career. I look young, but I'm 53, so I have a significant experience in investment, okay? I have a young-looking gene, but...
Keep working on GPI.
Yeah, but... I never had the gray hair before I joined the GPIF, but working for the public pension fund I started growing gray hair, but...
Well, very true with me. My mom just came to visit me a couple of weeks ago. She noticed, you got white hair now.
I know. So... What I was going to say, the reason that we had to report the $450 billion loss over 3 months, we lost as much as not as big as CalPERS, but the other major U.S. public pension fund has only $100 billion. Yeah. So we lost as much as major U.S. pension fund over 3 months. The reason why was I never seen in my whole career as an investment professional, every single asset class we lost money, okay? Because conventional wisdom of the portfolio diversification is like when we lose money in equity, we make profit in a fixed income, right? But we lost in every single asset classes, and we also lost in a currency translation as well. It never happened in the past. So I think it has something to do with the monetary easing, all those kind of things, which we actually created over the last decade. And we are now, facing the situation. Global market is so linked. When we wake up and find out the New York stock market, the plans, everybody expect the Tokyo market will go down as well. Right? It used to create the global diversification. So when the New York goes down, the Tokyo used to go up. But now every market move into the same direction. So this is actually what's really concerning to me. Whether the conventional wisdom of the portfolio diversification really save us. And no wonder why everybody is trying to increase a private, the asset or like a private investment, because obviously it's not correlated to the public market. But that's another thing. And the third one is, I still don't know whether it's going to be a, net positive or negative, but the AI going to replace a lot of jobs. But when the car replaced the horses, I think a lot of horse owners are very concerned about it, but in the end, we benefited from the car. So I don't know, we may benefit from AI, but for the time being, we will see the difference in some people win with that, and the other people will lose with it. And but this impact of AI in the business is going to be more significant than people think. So that's why one of the initiatives we are making is that we work with the Sony Computer Science Laboratory to use AI to monitor our asset managers' behavior. So there's a lot of room for our industry to use AI, but if you think about it, this is the industry where there are, thousands of $1 million bonus paid people, and I really don't think that all of them will be managed to keep that kind of high remuneration. But to conclude my answer to your question, I think how the AI will affect the industry landscape is going to be the big topic. Whether it's going to be negative or positive, at the moment I cannot judge.
Okay, thank you.
Thank you, and I feel your pain, Ben. When I started here, I had hair and this wasn't white, so. Ms. Oliveros.
Okay, so.
This one.
Wait a second.
Oh, yeah,
Ms.
so.
Oliveros.
Yeah.
Hi, thank you, Mr. Chair. I want to understand better your performance-based fee structure. It's a little different. I find it quite interesting.
You mean for the asset managers?
Yes.
Okay.
So if I understand correctly, if an asset manager doesn't perform in terms of reaching alpha, then they're paid based on a passive index. Is that correct?
Yeah. I think our new fee structure has been very controversial because basically we challenge the industry saying active manager seems to be remunerated much better than they should be. Not about the absolute level, but also the fee structure is not really, align our interests with the asset managers. So, as you know, the active manager performance is conventionally measured their performance relative to benchmark. Mm-hmm. And there's also the big debate in the finance academics that whether active management will deliver any value or not, because on average, mm-hmm. As you know, the active management has never beaten the passive management, mm-hmm. while they charge much higher fee. Right. So through our GPF's own experience, 80% of our investment team resource was used to select the asset managers and monitor them and etc. I mean, active managers. But in reality, net of fee, historically, our alpha net of fee was 0. So that means we wasted our resource spending energy on selecting active managers. But the conventional reaction to that was, you are not good at selecting good managers, right? So it's your fault selected bad ones. But in reality, if you look at the statistics, mm-hmm. active never, beat the market net of fee. So that's why we thought we need to change the rule of the game, to make it possible for us to win. And the new rule of the game we implemented was, active manager should be only paid as much as passive manager being paid if they don't deliver extra return. It's very simple. Yeah, it's very simple. And then, unfortunately, last year, GPF managed to save $200 million in active management fee because majority of active managers failed to deliver target alpha. But it will give us a much better chance when the market is better, right? We probably be able to get the alpha out of the active management. And then when you look at the long-term performance of our active portfolio, we pay very little when the performance is low, and we pay higher when they make the actual return. So the probability of GPF winning from active portfolio is now much better. Mm-hmm. And also, it makes a lot of sense, as you gave me some applause. They shouldn't be paid if they don't deliver something which they promised, right? Because unfortunately, I would recommend you to read some of the white paper about the fee proposal on our website. Mm-hmm. And it illustrates what the discussion we had with the asset managers, because at the beginning, all the asset managers trying to refuse it. They argued it's not fair, and GPF now again trying to use our power to hammer the fee. But what we said was, first of all, if you don't deliver alpha, you are just as good as passive, right? So you should be paid as good as passive. And we designed the participation ratio to break even at their target alpha. Mm-hmm. Mm-hmm. Right? So if they deliver the alpha what they proposed us, they should be paid as well, right? So they are. I told our asset manager, it doesn't make any sense you complain that we are trying to hammer the fee, because if you deliver what you are proposing, you receive exactly the same amount of fee. Okay. But throughout the GPF's, the history, only 18% of our active manager ever deliver target alpha. When you select the asset managers, and when you agree with your investment team, you ask them, how much alpha you are trying to achieve by taking this risk, right? So that's called the target alpha. And sadly, throughout the GPF's experience, only 18% of our active manager ever delivered the target alpha. So I said, this industry should be gone, because if this industry only less than 20% of product performs as what it says on the product box, that industry should be either eliminated or underperformers should get out of the other competition. But we managed to they managed to keep the industry intact while academics argue active management don't deliver anything. I still believe human can add value and active management can still add value, but we needed to change the rule of the game, so that we have better chance of winning and delivering alpha. So that's the basic idea behind the other fee structure.
Can we show slide 28?
Yeah.
Which illustrates your point?
So if I may add something to Ms. Oliveira's question. So this is just one of the many examples. Hero and GPF has been the thought leader in the industry. So this creative fee structure, once GPF designed it, not only they use it to their own benefit, they also put it out on their website as a white paper. And at that time, I was still working at SAFE. So my senior immediately forwarded me a copy of the paper, asked me and the team to study. So that's go to say again that Hero and GPF's commitment to the entire industry, not to GPF, to get better alignment for long-term investors, such as GPF and CalPERS. Yeah. So the paper, all the detailed methodology is on its website.
Thank you.
Okay. So this is the slide you want to put on?
Yes.
So actually, this is the one of very the many initiative we started, and but the fee structure, which has been quite controversial, but now actually 43 out of 46 our asset manager in the end agreed to this, and 3 managers who walked away, I directly discussed with their executive why they don't accept this, and one manager says they have they don't believe in they can ever deliver target alpha. And I said, why didn't you tell us 2 years ago? Okay. And then the other asset manager says, you know, we agree with this concept, but we have much easier money. Some of the other customers willing to pay fixed fee. Why would they have to take the GPIF? So I think this type of initiative, as Ben mentioned, I really call for the collaboration among asset owner to make it as a more industry like a practice. Another good example. Sorry, I just jump onto other issues, which is again transparency. When I was a GP, we used to hate CalPERS because CalPERS disclose everything. And we used to say the private equity market, like a CalPERS is not the other, the ideal customer, because once we partner, we get the CalPERS money, all the information will be disclosed. And now I'm at the GPIF. I'm telling our GP we are going to disclose everything, because the point is, when the CalPERS is only one, it will work against you guys. Mm-hmm. But if we join, and if other people will join, it will become market standard. Mm-hmm. So some of those things, as I mentioned, we have to be more strategic about the transparency argument. But there is something, if GPIF and CalPERS and some big asset owner decide to work together, we can affect the market. That's the reason we posted this in a public domain, because when I started negotiating with the asset manager, first thing they asked me was, are you going to disclose this fee to the public? And I knew my job would have been much easier if I had told them we are going to keep it secret to negotiate a fee. But we told them we are going to disclose this, because we had a very strong, the commitment to change the market practice. So, if the one party does it, it works against them, but it becomes the industry practice. It will change the things for the better, for the better of everybody.
Yeah. So this is one of the examples where here you mentioned early on strategic transparency. So what we should be more transparent, where we should be less transparent, how to best serve our fiduciary duty. So this is one of the examples of strategic transparency to the benefit of our beneficiaries.
Yeah. So the CalPERS is not going to be alone to disclose the fee on the private equity, because we are joining. But fee is okay, but the other things, some transparency requirement, which I used to hear from some of the public pension funds, including CalPERS, which really affect the private equity managers' ability to deliver outperformance. And so in some of those areas, I think the public pension fund board and executive team has to be more strategic. But it's not about hiding, but some of the things that we probably be able to just come up with the more strategic approaches. So can I just go through some of the other, the other initiative we have been implementing, so that I can, invite some other questions. Sure. And so this is a snapshot of our ESG investment. The first thing I did when I came into this position is to analyze who we are. And we are trying to find the best role model of the asset owner business model. And after 3 or 4 months search or research, I concluded we need to come up with a new theory or like a new business model, because nobody actually give me the impression that this is going to be a role model for us to mimic. So first thing we did was we actually tried to characterize who we are, and we concluded those 2 keywords should describe GPIF the best. One is universal owner, the other is cross-generational investor. Universal owner is actually, appeared in a classic finance textbook many years ago, but I was told by Harvard Business School professor, GPIF probably the first one to take that out of textbook into practice. So we basically own the wider universe of the capital market. So, the conventional wisdom of the asset management, which is how to beat the benchmark, how to beat the market, is not suitable for our, for GPF or the CalPERS. We are a universal owner because given our size, we won't be able to select, only the good performer, or when you look at the ESG, E is a good example, climate. I'm against the idea of divestment. The reason why is when we divest, ownership of those problematic company will be shifted from the responsible owner to irresponsible owner. So it doesn't make any difference because even that business is outside of our portfolio. If they continue to pollute the environment, we need to suffer, right? So the universal owner should pay more attention how to make the whole capital market or whole business or whole society more sustainable. Because that's gonna affect our portfolio somehow, someday. So that's one of the characteristics of the universal ownership. And when I spoke at the Harvard Business School, some student asked me, well, GPF, it's easy to understand you are a universal owner given your size, but what if I'm a CIO of like a small, the endowment or pension fund? Should we act like the universal owner or not? My argument was, as a community, we are universal owner regardless of your size. Because you may be able to outperform the market for the short period of time, but the long period of time, you are basically owning the global economy. So the universal ownership is a really, really important key characteristic of GPIF. And also, I think it should be suitable for the other asset owners. And a CalPERS, no doubt, you are a universal owner. And the other one is a cross-generational investor. We used to call ourselves long-term investor. But when I was making a speech at the CFA Institute annual meeting in Hong Kong, I asked the other panelists and also audience, what's your definition of long-term investment? Yeah, well, the most common one is 3 years. And the one young guy told me, I was told by my boss that anything longer than 3 days, you should take it as a long-term, right? Because they are like a hedge fund, okay? So I came to realize long-term is so subjective, and everybody seems to have a totally different time frame when we say long-term. And then I started using a super long-term. And one person said, oh, for me, super long-term is 3 months. Okay, I gave up on the long-term. So that's why. And then we started using a cross-generational investment because we are managing money not for the people who already retired. We are managing money for the people who are not born yet. Right, so that we are cross-generational investors. And when we cross-generational investors, everybody started thinking we are talking about 20, 30 years minimum time frame. And GPF's policy asset mix is designed to optimize our performance over 25 years. And we are definitely the cross-generational investors. So for the universal ownership characteristics and for the cross-generational investor characteristics, we concluded GPF should pay much more attention to how to make the whole capital market more sustainable. So that's the other sort of backdrop of all of our ESG initiative. And we have been asked whether taking ESG into account is against the fiduciary duty. And I said, fiduciary duty meaning you should be loyal to your beneficiaries. And if we think we are a universal owner, cross-generational investor, I cannot think of taking ESG information into our investment decisions against our fiduciary duty. So we actually made that statement very clear to our asset managers. And funny thing is, when I discuss with the asset manager individually, everybody tells me ESG is going to be, it probably is already, but is going to be the most important critical financial investment information for their portfolio management. And then our argument is, then practice it. Because if they think that transformation is going to happen over the time, we want to be the first one to do that. Right? That's how we can make the better return. So the GPF is really committed to become the ultimate ESG investor. To make sure our whole capital market is going to be sustainable. And inconvenience truth of the asset management is, as I said, we spend 80% of our resource trying to select the active managers, and we made a huge effort to build the alpha or accumulate extra return. But I don't know about the CalPERS, but my study is showing all the asset owners' effort to make an extra return every 10 years wiped out by financial crisis. That means the beta is so important.
Thanks very much, Hiro. I just wanted to flag a really practical example of how GPIF and CalPERS are putting these ideas into practice. And it's through tackling climate change, which is a systemic risk, also presents opportunity. But what we've done is team up together and form a network of what's now $34 trillion in investors that stretch from Asia, Europe, North America. And what we're doing is focusing on just over 100 companies where, again, we love data, just like you. When we did the analysis, Divya Mankikar did this important work, we found that these 100 companies are responsible for the vast majority of the emissions. So in other words, we can focus our attention and start to work with these companies. And our goal is a transition to get to 2050, to get to net zero globally. But we are confident that we can do this as long as we work in partnership, as long as we're focused, as long as we're long-term. And we're already getting some big results at huge oil companies like Shell, which has a written agreement with us, and many others as well. So I think what we're finding is that we can take this idea that GPIF has, that we fix the market through partnership and through engagement. If we walk away, we don't get the chance to change things. We just have to go and hide in a corner and hope it all works out. But actually, we need to fix it. And that's really what fiduciary duty is. It's getting things fixed. So I just want to thank Hiro for his personal commitment, because his role through our Asia advisory group, which Hiro and I both sit on, is actually now leading us to start looking at strategy for China, based on the success that you've led in Japan. I think it's a very, very practical and a very, very fruitful way of working together.
Yeah.
And then on the note of ESG investing, as Hiro just mentioned, that it's critical for us to catch the movement. But also with the investment, we have to be mindful. In the investment office, I share with the team, and we're actively researching this topic when it's ready. So I use the surfing analogy, right? We definitely would like to catch the wave, but you don't want to be too early in terms of deploying capital. If you're too early, you'll be, as Howard Marks once said famously, that if you're too much ahead of your time, this is indistinguishable from being wrong. But we need to capture the wave. And if it's too early, if too late, we miss the wave. We may be crushed by the wave. If too early, we take on too much risk, tracking error risk, and sometimes cost getting the market ready. But what we can do together, and also ESG topic is so broad. There are some strategies may be ready for deploying capital. Some strategy probably still warrants monitoring and research and gathering data. But we should closely monitor when the wave is forming. And if the wave is forming, we want to surf on top of that wave. And that's what we can do, form together as a partnership, continue to be the advocates of these topics, educate the market, the risk, so that we can create the wave together, and also we can serve together to benefit from the movement and the benefits of our members. So we have to be just a little bit cautious. ESG topic is so broad and they're so different. So we have to apply depending on what topic we are talking about. Which stage? Are we in the stage of research, in the stage of monitoring, or in the stage of actually deploying small amount of capital? But regardless, we need to join together to advocate these key long-term initiatives.
Can I say one thing about ESG investment? I think when I started advocating internally about the ESG investment, there are a lot of skeptics inside of my team. And I analyzed why there are concerned or skeptical about ESG investment. And one reason I found out was a lot of people think delivering extra return is only way to satisfy fiduciary duty. So whenever they discussed about the ESG, they try to address whether taking the ESG into the investment decision will deliver extra return over the market, right? So we now pay a lot of attention to index provider and the quality of index because we use a lot of passive management like the CalPERS. Passive management, if you decompose a passive management, is basically it's the index tracking and engagement with the company. Because they are actually the bigger owner of the company, right? So that we demand all our passive managers to actively engage with their portfolio companies. But basically, the passive management is a composition of their index tracking and engagement. We now urge our passive managers to engage more proactively with the portfolio companies, which the CalPERS do directly. But this index tracking, I think historically, we paid too little attention to index selection. Because we used to pick the whatever the most popular index as the policy index. But in reality, index provider dictate what we ended up holding. Yeah. So we started engaging directly with the index providers, and we tested several ESG-themed or weighted indices. And again, some people are skeptical whether this will fix the satisfy fiduciary duty if we underperform the benchmark. So we designed the benchmark to carry the same return and the same risk level, trying to prove we are bringing all our financial expertise to select the index, which is not gonna lose to the market. But obviously, some index, as I showed on the slide, underperform or the other overperformed. But we keep sending a message to Japanese public. GPIF, the ultimate goal of ESG index investment is to make Japanese capital market more sustainable. And because the index has much more powerful effect over the industry, because active manager has a dilemma. If they think this company is good because of for their ESG qualification, and when the price goes up, they need to sell it to realize the extra return. But the passive managers, they tend to hold almost perpetually. So they should be the biggest beneficiary of their long-term sustainability of the businesses. So that's why we have been very successful communicating with Japanese general public. And last year, there are more than 4,000 newspaper articles talking about the GPIF ESG investment. And 400. And almost every single article are very supported because they like the idea of GPIF trying to contribute to make the capital market and Japanese the business as a whole more sustainable. Okay, so that's the reason why we have to show some negative performance relative to benchmark with the FTSE Blossom Japan ESG index, but we didn't get much criticism. And the other thing I want to mention is fiduciary duty is one thing, but these days, as an investor and a shareholder, we expect the corporate executive to deliver a lot of different things. When I faced the other asset manager who was skeptical about the ESG 4 years ago, I asked them the question, what if your portfolio company CEO tells you, my job is to pay you the dividend, anything else, I don't care. I'm a CEO of this business. My job is to give you the shareholder return. I don't care about the corporate and the workers' welfare. I don't care about the environmental impact. I don't care about the gender diversity or social impact. How would you react? Every single asset manager of GPIF told me they cannot accept it. And if they cannot accept it, why they think it's acceptable to ourselves? So I think the investor has a responsibility. But it's not going to be mutually exclusive. We deliver financial return, but we pay attention to those risks. We achieve both. And we now expect the corporate executive to achieve both. Of course, we should expect ourselves to achieve both. So that's the other different way to take a look at the ESG, but it makes 100% financial sense, but I think beyond the financials, the justification, we are demanding corporate executive to do the same. And we are going to demand ourselves to deliver both. So that's the highest level concept we actually trying to convey. And sorry, Henry, I just forgot your question, the corporate governance. Yeah, okay. So the corporate governance, we regard it as one of the major topics in the ESG. Every year, we ask our asset managers which ESG topic you think are critical, and you are going to discuss or engage with your portfolio company on those issues. So they give us a list of the different ESG issues. And generally speaking, the list of the tops are usually climate and the gender diversity, those kind of things. But as far as our Japanese equity managers are concerned, the top lists are made of all the corporate governance issues. So I think for a lot of investors, one of the biggest weakness of Japanese businesses are the weak corporate governance. So that's actually where the Abe administration decided to make a reform, but also the investor thinks that the Japanese corporate governance is not very strong. So I think all our asset managers promised with us, because we make it very explicit in our stewardship principle. Our asset manager should engage with their portfolio company on critical ESG issues of their choosing. Right? So if they choose for the Japanese companies, corporate governance is the critical issue, they are required to engage with the Japanese company on that issues. And the one good observation to share with you was, we actually disclose this as well, but now we use 3 different index provider of ESG indices. FTSE and MSCI and S&P, and we monitor the correlation between the ESG rating by different index provider on the same company. And for Japanese corporate, well, you can see that on our website. We actually disclose a scatter map, and the correlation between the different ESG rating agency on the same Japanese companies are very little. Meaning the ESG rating has not been converged yet. And there are 2 possible explanations why. One, the sophistication of rating agencies is still not there, or data is not comprehensive. Both. Probably both. So we decided to promote and actually disclose those the other discrepancy to promote the more convergence. And over the last 3 years, we see much more convergence in the E rating. So I think the asset managers' view on the environmental or climate impact on their portfolio is started merging. S, it seems impossible, because when we ask them what kind of the topic they are actually evaluating in the S area, they actually evaluate different things. It's actually more difficult to converge. G is also not converging, because I think even if they have the same governance structure, the effect of the governance is very different from one company to another, or one market to another market. So it's much more requires the other, tailor-made, approaches on the corporate governance. So corporate governance is not only about the formality, but also it requires the real reflection of the corporate culture and also the other sort of market they are operating. But we think the corporate governance is a very critical issue for a Japanese company. That's what our manager tend to agree. Okay, thank you. Any other question?
We do have a few others. Mr. Perez.
Thank you again. This is probably more for Ben. Can we migrate to something similar to them as far as the fee structure for our managers?
Not only if can we have been benefiting from our team. As you know, that even before I came, CalPERS has been always driving the alignment of interest with our external managers and trying to cut down fees, improve transparency. So we are very proud to say that we are one of the global leaders, together with GPIF and a few other asset owners. But also we need also to balance. Currently, the market, as Hero will tell you, the market is really hot. And Hero already shared with you that the GP community, quote unquote, hate CalPERS because of our drive for lower fee, better alignment interest, and transparency. And we keep on saying that, we conduct ourselves very professionally, respectfully, but with the GP community, we're also friendly, but not really friends, because underlying, we are still not on the same side of the table. So again, back to your question, not only can we have been, and we have been very proud, we have been a global leader in this field.
And I think, yes, we ask for more transparency, but I think we're painted into a box because of the law here. Sir, there's been a lot of mention of fiduciary duty, but we're painted in even a stricter sense in that we're even in a smaller box than fiduciary duty, according to the California Constitution. So how would you? I'll read you a brief sentence of what the law says, and then how would you reconcile that with the idea of accepted fiduciary duty?
So here may or may not know the law you're referring to. I assume it's the open meeting law.
No.
No. Oh. So you may want to give here a little bit background what law you are referring to, the context.
Yes, sir.
Yeah. Thank you.
It says the members of the retirement board shall discharge their duties with respect to the system solely in the interest of and for the exclusive purposes of providing benefits to participants and the beneficiary.
That's the same as we have, what we have. The fiduciary duty is a very interesting concept that started in the UK and spread globally, but no constitution really has a very specific definition, anything better than what's you just described. And then my interpretation is basically what they are saying is we'll work solely for the benefit of our beneficiaries, right? And on the other hand, if you look at it from different perspective, that fiduciary duty concept started in the UK because it used to be a lot of political intervention into asset management. And also, there are a lot of the investment professional who try to make money for himself or herself at the expense of beneficiary. That's why they came up with the concept of fiduciary duty. Okay, now we have more than enough transparency that our investment team has no way to benefit their own, the purse or their own, make an investment for their own benefit. And also I understand the CalPERS and GPIFs are operating under the most stringent policy in terms of the sort of corporate entertainment and etc. So basically, I have no concern that the other investment team will get some personal benefit. So the first one, political intervention or some non-financial information get into the investment, right? That's actually usually came through board, not from the investment team, to be very honest with you. Because board is representing a lot of different stakeholders. It usually non-final discussions comes from our board too. Okay, because investment team is very busy trying to make money, and we believe, I believe that all the ESG factor is become a relevant factor for the investment. When I spoke on the Milken Institute conference, Henry Fernandez, CEO of MSCI, told me in 10 years' time there will be no difference between ESG index and a market-weighted index, meaning because every single asset manager we hire tells me they integrate ESG information into their investment decision, meaning over the time, the market will price that in. And so the other ESG index will become the same as the market index. But that things, I think it's really necessary for us to satisfy fiduciary duty, knowing those information will be priced in over the next 10 years. We should take that into account now. So, sorry if I sound like offensive to the board, but I think the board represents a lot of different stakeholders and different interests. But investment team usually only concerned about how to make an investment. So the older sort of the input, which I think is against my fiduciary duty, usually come either through our government or through our board. And I think it is the whole reason why CalPERS, I think, and the GPI has a multi-stakeholder board. California case, their board is all investment financial professionals. So they are technician or they are expert board. So they actually discuss the investment like the investment team discuss. But our board and CalPERS, I guess, sorry, I'm talking with very limited knowledge, but you are representing all the stakeholders. So sometimes, even if we think it makes sense financially, I don't mind our board tells me it doesn't make sense from their, the stakeholder perspective. But the investment team only focusing on how to make the best investment. And I feel very upset when our board or regulator tells me when I talk about ESG, I'm actually did not, bring in some non-financial information into my job. No, I'm actually using it because we think it's irrelevant financially. So I actually see no conflict between the other, how to satisfy fiduciary duty and how to take these into analysis. And thank you for talking about the fee structure. I mean, that's actually, no asset owner pays enough attention to, although I think it was against our fiduciary duty to keep paying the fixed fee, knowing their active manager never performed as they promised. Right. So I think I actually, asked the CalPERS board, and I actually, hope that our board is listening to the presentation, has to be a little bit creative and flexible, because I think conventional wisdom of the portfolio management is no longer perfect. And we need to think about other things. And you are representing younger generation started working at the police office, and they really care about the global environment. Of course they should. And I'll be very embarrassed. 2 days ago, we released our new ESG activity report, where we disclose our current portfolio aligned with like a 3-degree plus. So it's not meeting Paris Agreement. And an easier solution for us is just if we divest some of the other, fossil fuel industry, we can improve the portfolio analysis. But, I think as a universal owner, we only should be satisfied. We should sleep well when the whole market becomes sustainable, because it doesn't make any sense. Even if we sell some Shell, somebody owns the Shell at the lower valuation, so they actually make the financial benefit as well as they will continue to affect the whole our system. So sorry it takes too long for me to address your question, but this is very, very center of our work. You need to have a clear understanding what the fiduciary duty means, and that it should be created, because now we need to take a lot of more information into that discussion.
As you said, I'm a police officer, so I read the law, and that's the way I interpret it. And the way I interpret this, specifically when it says, for the exclusive purposes of providing benefits. It's not their well-being, it's not anything else, it's just, so to me, that means making money for the benefits.
Yeah, but we need to make money for a long term, that's the point. It's very easy to make a short-term performance if we don't care about those kind of things, but if we're talking about 30 years' time, 30 years' time, the people who are born today, will start working as a police officer. And we cannot leave the society which is not, the feasible for those generations. And I'm not philanthropist, I'm not the environmental activist, but, I actually showed that the GPF was featured in the Harvard Business School case study. And I was surprised when I was invited to speak to these students. 400 students attended the classes. They want to discuss how we should make the capital market more sustainable and more inclusive. Those 25 years old Harvard Business School students think they don't think the conventional capital market or like the capitalism will survive. So I think if you are running the business, you have to concern about how to recruit from those kind of the students' body. And everybody is asking the questions like whether working for this business is going to contribute to make the society better or actually damaging the society. I definitely recommend everybody to talk to the younger generation. My daughter just graduated from UK college and finally found a job, but she always asks the question in the interview, how can I contribute to the world by working here? That's the question I never thought of when we were young. And, the employer has to address that now. And the reason why we call it this kind of thing holistic approach is it's very difficult to prove our ESG initiative is adding value to our portfolio over the next month or so. Maybe over the next 3 years it's going to be difficult, but I believe that in 30 years' time, these kind of things will make a huge impact. And, GPF CalPERS, regardless of what we do with our portfolio, we are going to have exposure to the general economy. And if the general economy fails to be sustainable, we will fail to be sustainable. So I actually think that's going to address your question. That by incorporating ESG, we are going to secure the future benefit. And how long is it going to take to materialize? Probably 10 years, as the MSCI CEO tells us. But I wouldn't be surprised if it actually started materializing in 5 years' time.
Yeah, and if I may add some additional challenge we face at CalPERS than GPF in terms of being a long-term investor. As Hiro just mentioned, that at least in the next 25 years, there are no forecasted payout, but we pay out more than $20 billion a year. So we have to ensure that we can survive the short term so that we can thrive in the long term. So that's an additional challenge we had to face. And the other one, again, also, as I mentioned, that the plans for the fund run down in 100 years. So during a period, you just sell off the asset to pay the benefit, then you are done. You serve the mission, the historical mission. But CalPERS is perpetual. We don't have a timeline or plan to sell down the asset and terminate the program. So there's another additional layer of challenge that we have to face at CalPERS.
And I think another aspect is that we're hovering at 70%
Correct.
funded.
Right.
So, I mean, I'd have a little less heartburn if we were over 100%. But since we're since we're trying to get that, hit that discount rate and raise our funded status, I think we need to make money today.
So there'll be a balancing act. I just said we are a little bit different than
They will
GPF.
achieve both, of course. I mean, if we don't deliver the performance, we should be out of our job anyway. Right, so that's what I always struggle. Like the taking these into investment decision making. I think it makes 100% of the financial sense. But even the people who argue it doesn't will have to achieve both. Like that's exactly what we demand from corporate executive. Right, we expect the corporate executive to deliver a lot of different things, and we should be required or. We should be expected to deliver a lot of things together. So that's why we spend 1 year designing those ESG indices to perform in line with the other, the original benchmark, still achieving better ESG performance. So that's where those like a prudent expertise should kick in. We are financial expert. We know how to design index. And we spend hours and hours to design ESG index to satisfy the goal you mentioned. So all our index is designed very carefully not to underperform. Of course, sometimes underperform, but still that achieve the other goals at the same time. So unfortunately, we are living in a world. There are several surveys. The baby boomer, they think, during the other working age, they only focus on making money, and after retirement, they should make some philanthropy or donation. But the younger generation think they should do the both at the same time. And that's not only generation, but I think the world is changing, and that's exactly what we expect from our portfolio company executives, and then we should try to deliver the same. So if me or the bank don't deliver the financial performance, I have no question we should be fired. But
I'm proud of the work the investment team has done. I want to make that clear. And Beth does a fantastic job in this area also. The only glaring example that comes to mind is our divestment from tobacco.
We actually don't divest from tobacco. I don't want to create the controversy here, but
Too late.
It's supposed to be education and dialogue, right?
okay. Well, okay. I tell you what. GPF's ESG index is only one index in the world which includes the tobacco industry. Because generally speaking, ESG investors don't like tobacco. So all the existing already available ESG indices exclude the tobacco as the first negative screening. And the GPF made it clear at the beginning of our selection of ESG indices that we don't accept any industry divestment. So we demanded MSCI to actually score Japan Tobacco using the same ESG, like their scoring model, and we told them if they turn out to be very high ESG scored company, we include it. And as a matter of fact, it was included. So we are very popular with the Japan Tobacco and the tobacco industry. But again, I think it's also the board decision, because as I said, board is making the decision not only financially, because that's the reason why the board has the multi-stakeholders. So if you decided to, if the GPF board decided we should divest from tobacco, I'll divest. But simply, when we asked to make the financial decision, we keep it. And also, I feel uncomfortable because I don't know about California, but in Japan, the JT is owned by Japanese government. So I just thought it's a little bit of self-contradictory, like, the government pension fund divests from the company who owns by Japanese government. So this is another sensitivity. But I think this should be the clear distinction. Like, investment team make a financial decision, but sometimes board make non-financial decision. And if you ask us to make a finance decision, tobacco performed very well. But I have no objection if our board tells me to divest from tobacco for the different purposes or different reasons. That's a difference between the board, which is representing the multiple stakeholder interests or general interest. Our job is just to make a good investment. So,
Ms. Oliveras.
Thank you. This is fascinating to me. I'd like to go back to page 20 of your deck and take a look at the alpha, particularly under your MSCI Japan Empowering Women Index, 65.65%, right? Can you explain to me what that index holds? I don't want to get into individual investments too much, but I find that alpha intriguing.
Well, I'm very happy to see this women empowerment index overperformed, because I was most concerned about this index, which is likely to underperform. And it was actually recommended by some of our team members, it's safer, reputationally safer for us to go for the general ESG indexes, because it's not very clear where we underperform or they overperform. But when we selected this Women Empowerment Index, everybody knows that we are kind of betting on gender diversity's effect on the stock performance, right? And there are several academic researches that the company has a better gender diversity seems to overperform, but to be honest, I'm not sure, because it may be the company who has the more gender diversity, meaning that company's culture itself is better, right? So it's a kind of like which is cause and which is result, which is not very clear. So we actually made a strategic judgment. You know, when people talk about Japanese corporations, there are two obvious weaknesses the global investor always criticize about. One is corporate governance, which Henry mentioned. The second is gender diversity of women participation in the workplace. So that's why we decided to address it. By GPIF, the biggest owner of Japanese equity market, shows our belief in gender diversity. Will promote the more gender diversity across Japanese industry. And that's, again, our concept is we will contribute to make our economy more sustainable. So if you think the gender diversity contribute to the sustainability of the business, I think the CalPERS should invest into these indices. And our index is open for everybody, so I welcome the CalPERS to join. But I think, for the US, you already have the much better gender diversity. Yeah. But in Japan, we are catching up. So probably while we are catching up, we probably easier to make the shoulder improvement. And you may, even if you may create the same index using the US companies, you may struggle to overperform. But again, it's not about overperformance. These ESG index trying to send a signal throughout the system. Mm-hmm. The active managers, as Ann mentioned, because from the company's perspective, this guy may sell my stock tomorrow, yeah. Right? But the index, they know, they will continue to hold those stock for ages, right? So that's why it has much stronger impact on the whole industry. So it is a strategic decision. I'm very glad I saw the overperformance because I was concerned about if it didn't, it would actually send a negative signal to the market that gender diversity is not contributing to the corporate performance. So I'm really glad at the moment. And when I presented to Japanese Business Roundtable at their Gender Diversity Committee, they asked me whether I think this index will overperform or not. And I responded saying that if women work well, it should overperform. Because we only believe, all we can do is we believe in the company has the better gender diversity, will have a robust performance. But it's not us to prove it. It's them to prove. So please ask your investment to join us to support those kind of the gender diversity index because this is now toward the biggest gender diversity index in the world.
Thank you.
Thank you. Ms. Middleton.
Okay. I think some of what I was going to ask has already been asked, but to put it in very simple terms, it seems to me the case you are making is that ESG contributes to the long-term stability and sustainability of our markets, and that all of us have a vital vested interest in achieving that. Mm-hmm. And I think that is in part the answer to the question of should we be making short-term decisions that may have greater profitability for in the very short term.
Thank you. That's the sort of fundamental and the question we have to address. And again, I always tell my team, we need to achieve both, right? Because that's exactly what we expect from the corporate executives. They never ask investors, do you want the short-term performance or do you want the long-term performance? They never ask because investors demand them to deliver both, right? And I think I would say why we are different. So we have to deliver both. But there are certain cases we found is a bit conflicting, short-term return and the long-term sustainable performance. And I think it should be reflected in your investment belief and the characteristics of your fund. GPIF is that we are literally a universal owner and a cross-generational investors. I think when we face that kind of conflict, we should prioritize longer-term sustainable performance. But, again, coming back to fiduciary duty debate, I always find it's very strange because when people discuss about this is against or for pro fiduciary duty, they don't talk about the what kind of the customer they are serving, right? Because if my customer asks me to give their money back next month, of course I don't take the ESG into my account, my investment. Right? It's totally irrelevant, right? But if we are talking about 20, 30 years, I'm convinced that all those ESG issues are relevant, the factors. And the other thing I want to mention is I'm on a board of PRI where they try to to make advocacy of the ESG, and there's some difference in the opinion. Some people think ESG should be a source of return. The other people think ESGs are potential risks. And my observation is, it's almost unanimously agreed within the investment community, ESGs are contingent risks to portfolio. So if you have a trouble to justify or convince yourself that the ESG is a contributor to the future performance, just use that as a risk factors, because if you reduce the risk factors, your risk-adjusted return will improve anyway, right? So I think the other, you have to decide. As far as GPF is concerned, so far we have been using ESG as a risks rather than an opportunity. We use SDGs when we are trying to convey some future opportunities when we talk with the business, the business executives. But ESG, we basically use that as a risks rather than opportunities. But even if it's a risks, it will improve the performance because the risk-adjusted return is actually the real return you should get from the investment. Did I answer your question?
Very well.
Thank you.
Thank you. Mr. Miller. Where'd you go?
Thank you. One of the things that kind of struck me, and it's very refreshing, is this idea of kind of challenging the conventional wisdom that is widely held, not just by the public, but especially by the financial services industry and people in this business. And it kind of struck me yesterday, we were talking a little bit about the new normal when it comes to thinking about buy downs and recessions, that the conventional wisdom of 30 years ago just doesn't seem to apply. And the conventional wisdom of modern investment management theory from 80 years ago, ideas about market knowledge and valuation and efficient frontiers and all this and that, a lot of it doesn't seem to work anymore. And when you talk about the fees, this concept of pay and performance seems to leave out kind of the concept of Deming's red beads experiment, that you've got this big circle of luck or chance and this smaller circle of skill or competence at a minimum, and this little intersection that you're trying to reward. And we so often end up rewarding or punishing chance and basically wasting our money, that whole active passive thing. So my question to you is, are there other areas kind of the conventional wisdom which often seems to really serve the interests of the financial services industry more than us, that you see there's a new normal, that the conventional wisdom just doesn't really work anymore and we need to kind of break out of those kind of mental models or mindsets?
That's a tough question to answer because it's a really good question. For example, the benchmarking. The concept of benchmarking is created because customer didn't want to pay for luck, right? And also, the asset manager don't want to be penalized for something out of their control, and that the both parties needs matched and created that the conventional system of active managers are evaluated relative to benchmark. But if you are running the business as a corporate executive, you cannot tell the shareholders, like, we lost money because the market shrunk last year. It's not my fault. They wouldn't accept it, right? So in the real life, the people are evaluated both for their skills as well as lucks. And our recent the core research program with the Sony Computer Science Laboratory, AI came up with the what they call distiller to actually judge when the performance delivered by active manager, whether it was their intentional success or luck. And we came to realize some people has been consistently lucky. But, it may change our perception because, we used to think we need to segregate the luck from the skills, and we only should back the manager who has skills. But if we realize that some person has been consistently lucky and being able to deliver the performance to us, we should pick that one, right? So there's a lot of the new perspective we are bringing to our business. So even for the area of the asset management, of the way we analyze their performance, I think the conventional wisdom probably being destroyed or being challenged. But more broadly, to answer your question, I think we are facing a situation like nobody knows when this monetary easing contract, the finishes. You probably don't remember, but it was Bank of Japan who did the first quantitative easing in the history of mankind. And most of U.S. Prominent economists criticized the Bank of Japan, saying they are doing something really stupid. But when the Lehman crisis hit the market, everybody actually copied what the Bank of Japan did. And that was totally unconventional 20 years ago. Japan had a guts to experiment it, and now everybody copied. The problem is nobody has a guts to experiment how to get out of it. And I was hopeful the Fed will do it, but now it's going into a different direction. So we are now operating in a very, very sort of uncharted environment where every single major, the central banks printed tons of money over the last 10 years, and nobody knows how to close that. And I've been very surprised the market has been, not now, but if you remember 1 year ago, everybody thought the Fed will be able to maneuver or navigate how to exit from quantitative easing well. I was skeptical because nobody tried it. First trial is going to be bumpy all the time. So I really cannot specifically answer your question, but there's a lot of things which never happened in the past, and when we do for the first time, it's going to be very bumpy. Yeah.
Thank you.
That's something you mentioned a couple times, your colleagues about as well, the new normal. So what is the new normal? By definition, this is the conventional wisdom doesn't work in today's environment anymore. As a recent example, a few weeks ago, PIMCO put out a paper they call the negative nominal interest rate will become the new normal. And that's what we talked about yesterday. I highlighted that's one of the scenarios we stress test our portfolio. What if that became reality? Are we ready for that? And also I talk about how would capitalism work when capital is free or when capital is carry a negative interest rate. So that is uncharted territory. And if you extend that line of argument, in one of the scenarios could be when people say, what's the future of Europe? Look at Japan, that's the future of Europe. What's the future of us? Look at Europe, that's the future of us. Right? So in Europe now, again, the 30-year German bond nominal yield is negative already. And Japan is like the deflation and then disinflation. And Europe and we are in kind of a disinflation environment. So that can be one of the potential scenarios in the future. So back to your question, many of you mentioned the new normal. The conventional wisdom may not work in today's market environment. So we all have to be very mindful and keep thinking outside the box. instead of limiting ourselves to the conventional wisdom. And that's why dialogue like this is very helpful.
Thank you.
Thank you. Ms. Yee.
Thank you, Mr. Chairman. Couple thoughts. One, I need to just add my thanks to you here for your leadership, particularly through your participation and involvement in Climate Action 100+, which really, I think, just brought about the entire Asian community, the continent of Asia, to the table, which is so key in terms of where we need to move. And perhaps this is a bit of synergy, but I'd like to think without as much skepticism as I currently have, but our own Business Roundtable just yesterday has also kind of declared a different way of thinking about how to bring about value, and made declarations that generating shareholder value is not going to be their main objective, and understanding now, and I believe a lot of this is because of the engagement that we've had with them globally, and understanding that the world is changing around them, but that value really needs to be about how they value their employees, their suppliers, the communities in which they have a presence, and I think all of this is just really additive in terms of how we're going to look at all these issues in the long term, but I think it's additive with respect to how we're going to sustain our markets going forward as well. So I just wanted to make that statement because obviously this is top of mind for not just the pension funds, but just in terms of how we just kind of do business in this kind of commonplace now around the world. I think there's a lot of thought that's evolving, which seems to be at least going in the right direction, similar direction.
Thank you. I think the yesterday's the business roundtable, Jamie Dimon's a statement about the shareholders' value is no longer the primary purpose of the business, which we should argue that he should have said the shareholder value is not only primary goal of the corp businesses, right? I mean, this is again it's not going to be ESG or a financial return argument. They should achieve both. So I think the others, we are steward of our beneficiaries, that we need to make it clear they cannot use it as excuse not to deliver the shareholder value, but which I think is important. But I think that's another evidence. The people like him started thinking differently, and now they feel the pressure that they need to serve the other stakeholder to remain the business. And one other things which they talked about was the pay gap, gender pay gap, or the income inequality. That's the S issue, but it's going to be create a lot of social issues, and we are not safe, or we are not distant from what's happening in the society. What your democracy of the United States brought up to the world actually affecting a lot of our investment, right? So the political decision affect the performance of our portfolio as well. So I think that conventionally, investment professional, you spend the day looking into the Bloomberg chart. Now I think we should pay more attention to what's happening in the world from the broad perspective, and what's happening to the society, how angry the young people and some working classes is going to affect our portfolio. It's already affecting. I was involved in a G20 meeting, and some of the other sustainability agenda was vetoed by U.S. federal government, and so there's no discussion on those topics, and that's actually the consequence of your democratic choices. So I'm sorry, I have no personal opinion on that, but I'm just trying to convey the time the investment professional used to spend the whole day watching the Bloomberg TV screen has ended.
Thank you. No other requests to speak. Anything else, Mr. Mang?
I think I just want, in conclusion, I really want to thank Hero for the thought-provoking talk, the dialogue with you, and also thank him for making the special effort to come to us. He flew in from Tokyo last night just to talk to us, and then he will be on his way to London to see his daughter. So he's really making this a very special trip for us. So thank you.
We're very honored to have you be here. Thank you. Guys.
Well, just to give you my last word, thanks again for inviting me. It's my honor to present, the GPIF initiative and also my own thought to the CalPERS board. And as I put in my final slide, I think asset owner should work together to achieve a lot of things. And even just the fee for the asset managers, we can work together and to make our business more sustainable and more aligned for the benefit of our fiduciary. And thank you very much. We always regard the CalPERS our closest, the sister or the partner. So thank you very much for inviting me today. Thank you.
Well, it's been our pleasure and honor to have you here, so thank you. With that, we're going to take a 10-minute break. We'll get 11. We'll reconvene at 10:45.